All right, let's do some questions on cycles. Question number 9. It says, sound internal control dictates that immediately upon receiving checks from customers by mail, a responsible employee should what? So we get this thing in the mail and we open it up and it has a remittance advice and a check. Remember, what do? The person that opens the mail takes the check, prepares a remittance listing. They take the listing and the check and they give it to one person for depositing. They take the remittance advice, give it to accounting, and that's for recording. So we're separating what? Custody and recording. So those two get separated. The person that opens the mail should do nothing else in ARC, maybe a receptionist. The one thing they do also, besides prepare a remittance listing, a listing of what came in, also they stamp or endorse the check for deposit only, so no one else can write their name on it and cash it. So they should, A, so nothing else in ARC. Add the checks to the daily cash summary. That's recording. They shouldn't record. B, verify that each check is supported by a pre-numbered sales invoice. They don't have the invoices. That would be the accounting department's job. Prepare a duplicate listing of the checks received, a remittance listing. True. Record the checks. They don't record. So again, keeping the mnemonic ARCs clear in your head makes these questions easier to do. Number 10, tracing shipping documents to pre-numbered sales invoices provides evidence that what? Tracing shipping documents to invoices. So the key is invoices or shipping to invoices. Let's look up here. Sounds like the revenue cycle. So here's the sales order, authorization to sell. Here's the bill of lading, custody, shipping to invoices. So if we're going this way, that is called what? Tracing. If we're tracing, can you see the word tracing? Tracing this to this. What does it tell you? This tells us what was ordered was shipped was billed, was received was deposited, and it reconciled. Okay, what got received, custody, actually got recorded and deposited. So that's the normal flow. That tells us the transaction was complete. What if we went the other way? What if we started here with a receivable and said the receivable occurred from a sale, the sale was actually shipped, the stuff shipped was actually properly authorized or ordered? That would tell us that the receivable exists, or this transaction actually occurred, existence occurrence. So this way is existence occurrence, this way is completeness. Make sense? Okay, so this tells us everything ordered was billed, everything billed was received. So they're asking about this, billed was received. It says, A, no duplicate shipments or billings occurred. You'd have to look at the whole population of items. Shipments to customers were properly invoiced. Shipments were invoiced, maybe, remember, don't commit. C, all goods ordered were shipped. That would be order to ship. That's from the sales order to the bill of lading. Ordered were shipped, shipped were billed, billed were received. All pre-numbered sales invoices were accounted for. That's PPN, pre-printed, pre-numbered, numerically controlled, which we talked about in the past as well. That's not it. Best answer is B. In testing controls over cash disbursements, cash going out, an auditor most likely would determine that the person who signs the check should what? So this is cash disbursements. Which cycle is that? That's this one called the expenditure or spending cycle. This says requisition, the department head requisitions goods. They make sure the goods are within the budget, what they need, and so on. They then prepare a purchase requisition. They keep a copy, send a copy to purchasing. Purchasing prepares the purchase order, which is the authorization to purchase. The authorization to purchase then, a copy of it goes back to them, a copy goes to payables, a copy goes to the receiving department with the quantity blocked out. They keep a copy. The goods come in, they prepare a receiving report, they fill out the quantity that was received, send it to payables. Then we get the invoice, invoice goes to payables. Payables compares what was ordered, what was received, what was billed, proper item, proper quantity, proper price. Payables then prepares the voucher called an authorization to pay, a check request. We then give this whole thing is called a voucher package. This voucher package then goes to the person with custody of the cash called the treasurer. The treasurer then signs the check. What is a good control? They cancel the supporting documents, right? They stamp it with the, I remember when I used to pay bills, I would cross it out and write the check number and the date. So if I had a question about it, I could go to the file, pull it out and go, oh, here it is, let's go find the check. So at that point, they stamp it or cross it out. Then who should mail the check? The treasurer's department, right? You've got a signed check. You don't want it lying around. Then we send it in here with the remittance advice and the check. We send it over. Notice this is someone buying. This is someone selling. Here's the check and the remittance advice coming into the company. They do their side. We do our side. So what was the question? I forgot. In testing controls over cash disbursements, an auditor most likely would determine that the person who signs the check should what? Mail them. A, review the monthly bank rec. That's comparison. That's not the treasurer. B, returns the checks to payables. No, we send them out. Is denied access to the supporting documents? No, because before the treasurer signs the check, they need to look at the documents, make sure it looks correct, and then cancel it, right? Embossing it, stamping it with the date paid. And then is responsible for mailing the checks? Yes, they should mail the checks. Best answer D.